Alrighty, guys, this is gonna be the last video in our this first series. It's gonna be dividends. It's gonna be like kind of like an add-on on top of the shares slash ETFs. So let's go ahead and get into it. What are they? Why are they useful? So let's start off with what are dividends. Like I mentioned in the past, certain stocks do pay out like an interest or a reward the people who do buy and hold onto their shares for a set amount of time. It's usually every 3 months, but some stocks even do like once monthly. What are they useful for? If you have enough shares and uh, the dividend payout could be big enough to even like pay off your bills, pay for vacations, or even live off of them. So that's pretty dope. The only thing that sucks about them is that you need like a big enough amount of them to make a substantial amount of money. Usually, you can see somewhere between like 4 to even like 7, possibly all the way up until 30%. But once you start getting to those higher percentages of payouts, you got to be a little bit skeptical about those. So how do they work? What dates to look for? So basically, companies usually have this thing called the earnings report. And I'll go more into depth on what it is and what to expect from those and how stocks react around those times. But basically, they usually announce the next time they're going to offer dividends or whether they're actually going to do dividends or not. Which usually, if a company does do them, they're always going to continue to do them. And especially, we'll get into later of ones that you can rely on for dividends. But basically, this is the date. The declaration date is whenever they decide the next payout for their dividends. Again, announced during earnings reports. The ex-dividend date is the cutoff or the final day you can buy shares to actually qualify for that dividend, for the payout, basically. Um, After that, if you buy any shares, they're not going to be eligible for dividends. You can still own them and you can still flip them. I guess you say buy low, sell high, and it doesn't really concern you. But if you plan on holding them long term, you end up getting paid out this dividend. The record date, it's not necessarily important. Well, I guess it is, but it's basically the company itself is the one that looks for the record date, and it basically tries to count and tally up how many shares you own so they can know how much to pay you out. This is usually after the ex-dividend date, so it's not really as important, like I said, because you either have the shares by the ex-dividend date or you don't. And the ex-dividend date is kind of given through the brokerage that you use, because at the end of the day, let's say Coca-Cola, for example, they don't pay you directly. They pay the money to the brokerage, which the brokerage then gives out to everybody who actually bought shares. And then the payout day, obviously, is whenever they distribute the dividends. Whew. I'm sorry, I got winded for some reason. COVID. No, I'm just kidding. I already had that shit. Apparently, I'm asymptomatic, but we're enough about COVID. We're talking about investing. So, qualities of ex-dividend date. I mean, of other qualities of dividend companies. Or what are the tax benefits? Usually, companies that meet the following standards pay out dividends. They have a large amount of cash on hand. So usually, these are going to be like banks or established companies that've been around for a long time. They have customers that come in and out. I mean, not coming in and out. Usually, have customers that last with them over time. And it's a good sign to have cash on hand because if you don't have cash on hand, that means that you're in debt. Companies that make routine income. So cell phone providers are usually the ones that make routine income. They know how much they're going to make at the end of each month. Yeah, the number of customers fluctuates, but at the end of the day, they know when their customers are going to have to pay them. Also, companies that do not have much money, that do not spend much money on research and development. So basically, like companies like Tesla or Apple, they're always trying to invent something new. So they're not going to pay out that big of a dividend or any dividends at all. The companies that kind of have like a set stuff of what they do already as it is, and they're not really going to change anything about their company or their model or whatever they're making, those are the ones that can pay out like the higher dividend, I guess you could say, per se. So like Coca-Cola. Coca-Cola has their set product that they have. Every once in a while they might come up with a new flavor for like the holiday or for experiment, but at the end of the day they have their main products that they have. Also, dividends are taxed at regular income rates unless they qualify for exemptions or even lower taxes. So basically, the ones that do qualify are the ones that when the company that you work for gives you them as a bonus or for payment or for anything like that, those are taxed differently. And sometimes they can even be for free if you make less than a certain amount off of those dividends. So it works for you if you work for big companies that do pay dividends. So important topics within dividends. Either like this is going to be kind of like vocab, or even stuff to look out for whenever you are trying to get into stocks that do offer dividends. One is the dividend yield. This is a percentage. It's basically the payout divided by the stock price, and that gives you decimal, but you want to use this as a percentage. So let's take this. Oh, that's not supposed to be cool. Hold on, let me. O example. And if we look at what O is, this company has I think it's medical real estate that they have, and they offer a lot of dividends. So monthly dividends, I mean. So as you can see, they're paid out monthly, and it's increasing slowly over time. So the first one, not the first one, but they start off like at 23 cents. They make it up all the way up to 24 cents, and you see this eventually raising to 25 cents. But basically, you take the day of what the ex dividend date, which is for them. Let's say it was the earnings report date. For the example, though, I use this date here. So you take the ex dividend date, which is this day and time, and then you find the next day when they actually paid out the dividend. So then you go back to down here to find out what that is. So they found the payout, and then the stock divided by the stock price. So if you would have bought the stock price on 11/30, which is this date right here, the average is about 68.5. So 68.5, you bought it on that date. The dividend payout though is going to be a month from then, which is December 31st. The stock price now is at like 71.5. So the dividend payout is 25 cents, which is you found out a month later. Since they do it monthly, it's gonna be every 12 month. 12. You're gonna multiply by 12 because in order to get the percentage, so you divide how much they pay out, which is the 25 cents, by the stock price of what you bought it for, which is 68.5. You multiply by 100 in order to get a percentage. And again, since it's 12 months in the year, they pay out monthly. You multiply by 12, so you're gonna get a 4.41% interest. I mean, not interest, dividend based off the stock price that what you bought it at. So this is just for holding. Technically, you could sell the shares for more profit too. As you saw on the chart, it increased in price from November to December, approximately 4% as well. And then another thing we look at is dividend growth. So dividend yield growth year after year is definitely a strong sign of growth within the company itself and what it has to offer future dividends. Let me go and get off of that. Let me put this back in the slideshow form. But dividend growth. So year after year, if you see the dividend yield increase, or even the dividend itself increase over time, that's definitely a good sign of the company, showing that it's growing and it's not losing customers or losing revenue, or it's not losing anything of itself. If the company stock price increase but the dividend stays the same, it's showing the dividend yield will get smaller because again it's a percentage. So you definitely want to see growth in the dividend, and you also want to see growth in the company price of the stock. But if you see the percentage increase, that's even better if you can have both. There's something called drip investing. Is whenever you take the dividends that you were paid out and then reinvest it into more shares, and then just constantly do that each time they pay out money, which definitely accumulates over a long time. It's basically compounding money. But not only do you compound the percentage, so let's say in this example it's 4.41% each year, you're also increasing in price. So this is also pretty cool because this reminds me of crypto. I'm staking one of the cryptos I have, and what basically happens is that I'm earning a percentage on it, but the percentage is paid out in the token itself. So let's say I have 100 and they pay me out, let's say at 5% annually. So that's 5 extra of the token that I get per year. So at the end of the year, I'm gonna get 105 of the token. But if the token increased by 3 times, then technically I'm actually making 15% of my money rather than 5%. The same thing happens here with this. If the stock increases over time and you're compounding what's called how much of the stock you have, you multiply the price of increase also by how much stock, percentage of the stock you're getting back. So that's how, again, how rich families stay rich, because they're constantly accumulating more, and it pays out more over time. So something else to keep in mind is, what is a dividend aristocrat or a dividend king? These are stocks that have experienced dividend growth in the dividend payout over the past 25 years. Examples are AT&T, Chevron, Coca-Cola, Johnson & Johnson, and Cisco. This shows like strength in the company, growth in the company, that they can consistently pay out more and more each year. Shows that they're good. They're good in at what they do, the service they provide, and the consumers that use their product increases over time as well. Golly, I'm serious. I'm sorry. I don't know why I have so much fucking gas, burping, hiccuping, and shit. The payout ratio. Okay, so percentage of the company's earnings that go into going to pay dividends. If a company has a really high percentage of the amount of earnings they make and they pay out dividends, um, this is usually a bad. I won't say a bad sign, but it's something to question, because if they're using that, they're trying to make their stock look attractive to investors. So a lot of people get in. But the thing is, though, is if a lot of people are getting that, it means the company now has more money than what they started with. So they can either use it to pay debts that they have, or they might use it for their own good, if that makes sense. They're not actually furthering the company, they're just taking advantage of past debts they have, or use it for their own personal use, which is not really good, because it's going to drive the stock price down. But if it's a low percentage, then that means that the company, it doesn't necessarily mean that it has to be, but it means that the company's doing a little bit better, because now they're able to pay out a good, relatively high percentage, or not percentage, dividend, without sacrificing too much of their earnings that they have. Something else to keep in mind is free cash flow. So this kind of ties into the payout ratio. This is like how much cash they have on hand. So like Apple's like has one of the biggest cash on hand companies. That's why they're able to be still have research and development, which is when they're looking to make better products and they're investing their money into themselves. But they also have so much money on the side that they're still able to pay out dividends. So they're able to do the best of both worlds. So you'll see the company stock increase by a lot, and you also see a dividend, which is rare in a company that still has research and development. Also, it shows that dividends are sustainable, and it's not just going to be for that one payout. It's not going to be for just the next year. It's going to show that over time they could consistently do that if they do have a big amount of cash on hand. Yield trap. So if something's too good if it seems too good, it probably is too good to be true. Above 8% to 10% a year should raise a red flag. Makes you really want to research into that company and say, is this really something I want to invest in? If it's high, it's normally for two reasons. One, they, again, like I mentioned earlier, they used all that money, all that incoming money. They try to make their stock look attractive with this high dividend in order to get people to come in. And now that people came in and bought pieces of their stock, they can use that money for something else, and that ends up driving the stock price down. So even though you're making good dividends, the drop in the price of the stock is outweighing how much you're making in the dividend. So technically, you're still losing money even though you're making a good amount off the dividends. Also, it indicates that either that or their stock price fell so much, their dividend yield percentage increased. So again, it's a percentage. It's how much they pay out divided by the stock price. So if the stock price goes down, it makes their percentage look higher, which honestly isn't that bad if it's a good company. But you have to find out why it fell by so much. Because if it's for a legitimate reason, like it changes the fundamentals of the company, then that's probably is a good sign not to get into it. But if it doesn't change that, then that's honestly a good steal. Because let's say for Coca-Cola, whenever it dipped during COVID, you see the yield go up on their dividends. But the thing is that Coca-Cola is a sustainable company. And the reason they fell was because of COVID, not because something changed within the company. So it's definitely a good buy over long term. And even now they're like at $70 versus like $40 when they were at COVID. So it's like what, 20 per, I mean not 20, a 50% increase. On top of that, their dividends increasing. That's actually a decent percentage. That's a win-win situation. As you can see, these slides were mixed up because dividends was supposed to come before the stocks. The shares were supposed to come, then the dividends, and then the ETFs. But I kind of did shares and ETFs together, and now I did dividends. But as you can see, there's different ways to worry about your long-term investments. You do a retirement account. You could trade shares. You could put money into ETFs. You could put your money into shares that pay out dividends. You do covered calls. There's a lot of different things you could do for long-term investment that's considered more safer. What to expect next, though? I'm going to end this slideshow and just kind of zoom in on what I got to say. What to expect next, though, is that we're going to start looking at charts and learning how to trade, how to read charts, how to predict what's going to happen, not only just based on what you see on the chart, but news that's possibly coming up, and doing something about it. Basically, being able to do these trades, but how to do it in not a low risk, but manage how to manage your risk basically by having a trading plan. So we'll get into that next in the next series.